easing of inflationary pressure in the UK economy. And this is shown in chart 3. While their levels remain elevated, measures of underlying services price inflation have continued to diminish. This has happened as pressures from non-labour input costs have faded. So persistence in wage growth is now the main driver of continued high levels of services price inflation. My second key message is that a small margin of slack has opened up in the UK economy, and we expect it to widen over the next couple of years. Heightened uncertainty, weak productivity growth, and the continued restrictive stance of monetary policy have all been weighing on GDP growth recently. Businesses have been cautious about investing. That's the message we're getting. And while real household incomes have risen quite strongly, consumption has not followed suit. This weakness in demand has coincided with continued weakness in the potential supply capacity of the UK economy. Productivity growth has been weak. Nevertheless, labour market developments, survey indicators of capacity utilisation and statistical estimates all suggest that weaker demand has led to a small margin of economic slack opening up. Looking through data volatility, we expect underlying GDP growth to remain subdued in the near term before economic activity starts to pick up later this year as household spending and business investment recover, supported by a downward path for interest rates. We expect housing investment to strengthen too. Assuming potential productivity recovers some of its recent weakness, that pickup in GDP growth will still probably go hand in hand with a wider margin of slack. This takes me to the third key message. An emerging margin of slack in the UK economy should act against any remaining persistence in domestic wage and price setting to return inflation to the 2% target sustainably. A normalisation in wage growth is particularly important to ensure that services price inflation continues to fall back to levels consistent with the 2% target for headline consumer price inflation. Now, this process has still some way to go. Annual private sector regular average weekly earnings growth was 5.9% in the 3 months to February, having risen in the second half of last year. Now, that level in February was slightly lower than we'd expected in the last monetary policy report, however. And as chart 4 shows, underlying measures, estimated by the bank staff, have been more stable and point to a slightly lower rate of wage growth. And as we look ahead over the course of this year, we expect wage growth to moderate with a loosening in labour market conditions. This is supported by forward-looking indicators. The bank's latest decision-maker panel survey suggests that wage growth will be about 4% for the year ahead. That's the yellow diamond on this chart. And the bank's agents point to average pay rises for 2025 be between 3.5% and 4%. That's the purple diamond. With the continued easing in labour as well as non-labour costs, further declines in services price inflation will support a gradual return of headline inflation to the target as we look beyond the near-term increase. Now, as shown in chart 5 here, in our baseline projection, conditional on the market-implied path for bank rate, inflation gradually falls from later this year to reach around the 2% target within 2 years' time. My fourth key message is about the global economy. New tariffs and elevated trade policy uncertainty weigh on global activity. We expect global trade prices to be materially weaker, particularly in China. The US administration has made a series of announcements with significant changes to tariff policies. Some of its trade partners have responded. Volatility in financial markets has accompanied these announcements. Slower growth in the global economy is likely to reduce the demand for our exports and impact economic activity here in the UK. That reduction in external demand will also work to reduce inflationary pressures in the economy. But while the impact of what we have seen so far is likely to push inflation down somewhat, the overall impact on inflation remains uncertain. On the one hand, lower US demand for global exports, particularly from China, could lead to lower global export prices and hence lower prices in the UK, reducing inflationary pressure further. On the other hand, higher costs in the global supply chain, as intermediate inputs are subjected to tariffs or because of disruptions, could push up on prices. And while sterling has appreciated in recent weeks, easing inflationary pressures, global exchange rates can shift in response to trade policy news and the evolution of global risk sentiment. Although they understandably dominate the headlines, it's important to remember that global trade policies and how they affect the UK economy is only one source of risk to the outlook for inflation in the UK. Let me say just a word about the news, obviously, that has been coming out in the last few hours about the prospects of a US-UK trade agreement. We obviously follow this very closely. We haven't been briefed, so I'm speaking without knowing the content of the agreement, just to make that clear. That's as I would expect. But we do now have news that suggests there will be an announcement, and we welcome that news. I very much welcome it, and I think it's very well done to those involved. And the reason for saying that is that it will help to reduce uncertainty, and that's important, as you will see in the context of what we've said today. The UK is, though, a very open economy. So the UK is also affected by the way in which trade policy and tariffs affect, obviously, other economies. That is, in other words, the tariff measures that have been taken in respect of other economies. So I say that because I hope the UK agreement, if it is indeed announced this afternoon, will be the first of many. This will be good news all round, including for the UK economy. But it is excellent if it is indeed the case this afternoon that the UK is leading the way, and I do congratulate both those in the UK who are involved and those in the US too. So the MPC is alert to a range of risks in both directions. Domestic inflationary pressures could persist for longer than we expect, despite the progress we've made, or they could ease more quickly as the margin of slack widens. The balance between supply and demand in the UK economy and how it will develop over the forecast horizon also remains very highly uncertain. We need to watch very carefully for any signs that the near-term increase in inflation could lead to additional second-round effects on wage and price setting, although that's not our central assumption, but also for any further weakening in demand, which would reduce inflationary pressure. Now, with this in mind in the Monetary Policy Report, we present two scenarios in addition to a baseline projection for activity and inflation to illustrate some of these risks. In one scenario, there could be weaker supply and more persistence in domestic wages and prices, including from second-round effects related to the near-term increase in headline inflation. In the other scenario, inflationary pressures could ease more quickly owing to greater or longer-lasting weakness in demand relative to supply, in part reflecting uncertainties globally and domestically. Considering all these risks, we will continue to monitor closely the accumulation of evidence on the outlook for inflation over the medium term and set bank rate accordingly to meet the 2% target. So to conclude, our restrictive stance of monetary policy has reduced inflationary pressures in the UK economy. With the progress we've made, we've been able to take another step in making monetary policy a little less restrictive today. A gradual and careful approach to the further withdrawal of monetary policy restraint remains appropriate. So with that, Claire, Dave and I will be happy to take your questions. Thank you.
Great. Let's start with Ed and then Sam, please. Ed's right behind you.
Thank you. Ed Conway from Sky News. Governor, could you say a little bit more about what impact you feel that tariffs are likely to have on the UK economy, and to the extent, I mean, you pointed out that we are, we're affected by what goes on globally. To the extent that there could be a deal in the UK, how much of that 0.3% or so of impact might you hope for this to eliminate?
Well, we've set out. Let me just explain a bit about how we approach this question in the round, and particularly in creating the Monetary Policy Report. The staff proposed to us sort of two ways to sort of, in a sense, take that into account. The first one, as you say, Ed, is the tariffs, the impact of the tariffs themselves, and then the second one is the impact of what we've called trade policy uncertainty. And that's obviously particularly relevant because we had to face the question. We always condition our forecasts on announced policies. Obviously, you have to stop. You have to stop the music at some point. and take the policies as they are. And that's obviously quite a challenge in the current environment, because obviously we expect the policies to change, and of course the policies also have changed during the course of doing this round and doing this forecast. And so that's why, I mean, I think that bringing in the uncertainty element is very important. So you asked a very good question. How do you think a trade agreement is going to change that? And I'll just come back to what I said a few minutes ago and take it in two parts. There's a direct effect in the UK. Now, as I say, I don't know what's like in what we expect to be this agreement, so we'll have to wait and see how that comes through. We have the rough metrics for UK trade, UK goods trade, and of course UK goods are a smaller part of UK trade than is often the case for other countries, because we have a very big trade in services in this country. But I just emphasise finally the point that I made earlier, which is that the UK is a very open economy, and therefore what we also had to do in obviously in thinking about this forecast, and we'll have to do in thinking about the next question, as you say, is say, well, what is the effect of the impact on other countries' trade as it will then pass through to the UK? And as I hope, what will be the effect of other trade agreements that come to pass? And we'll have to factor that in, because it is important. That is important for an open economy like the UK.
That's Sam right there.
Thanks. Sam Fleming from the Financial Times. Just following on the same theme, obviously in these forecasts, the impact from trade to growth and inflation is extremely modest, actually. A 0.3% hit to GDP in 3 years' time, 0.2% off inflation in a couple of years' time. Yes. Could you talk a bit about why you're so sanguine about the impact of trade? Can we take it therefore as a corollary that you expect any upside from this trade deal, potential trade deal with the US as being very modest?
Yeah, thank you. I would just make one very, very simple point at the beginning, which is that I think it's important not just to look at the trade impact, but also, of course, to look at the way financial markets have moved in response to the news on trade and that impact. I'll hand over to Claire to...
You've taken my punchline, Andrew. No, you're right. The overall numbers look quite, may appear quite small, and that's because there's sort of three channels that are going on and have impacted the forecast here. So the first, as Andrew said, is the actual direct tariffs themselves and the impact that those will have on the goods traded and their effect. So you've got the tariffs at the time at which the forecast stopped, and those will feed through onto growth and onto inflation directly. You've then got the effect of the trade policy uncertainty, and you can see in the charts that we've published just how high actually that's been. We've got these metrics that we can use there. You can see the size of that. And of course that feeds through in multiple ways through the economy, but obviously will feed through to investment, particularly for those firms who are uncertain about what that means in terms of investment going forward. It will feed through into consumers as well and might be affecting some of the behaviour you say there. So you've got this trade policy uncertainty component that is large and larger. And then on the other side as well, what you've got is some quite large changes in various financial markets that we've seen responding to these things, whether that is through interest rates or exchange rates. And to some extent, the effects have been offsetting, as you would expect, and that's why in net, when you look at the numbers, they're not huge. I would say this is not the case that we're not sort of focused on, looking a lot at, doing a lot of analysis of these numbers, but really it's these effects, and to some extent they've been offsetting in these data. I should also say, of course, there's a lot of uncertainty around this, and this is a sort of central view. All of these factors could change, will change, or could be quite different going forward.
And we talk a lot about uncertainty, and not just at this press conference, but it's been a prevailing feature. There is also, and we emphasise this, there is also now unpredictability, and that has also fed into markets. So you've seen quite a lot of volatility. Obviously, we've conditioned on the assumptions that we set out, as Andrew and Claire have emphasised. But at the beginning of April, for example, we saw a lot of volatility reflecting just the news flow.
We'll go Sue and then Faisal.
Hi Sue Chan from The Telegraph. Just on that theme of uncertainty, looking at your scenarios, would more trade uncertainty, as outlined in that scenario, lead to faster rate cuts, given the amount of slack you say will open up under that scenario?
Yeah, let me talk a bit about the scenario. You're right in that. So what we've done here basically is think about, well, look, what if the economy evolved slightly differently in a couple of key ways? And the scenario that you point to there is one of weaker demand, and that could be driven by higher trade policy uncertainty. There's something else going on in that scenario, which we've also said, well, what would happen if that was to change the relationship between the amount of slack in the economy, the kind of pressure on resources, and pricing. So you've got both of those effects going on in there. Now, I mean, what we've said is actually if you make some assumptions about how big those changes could be, you know, sort of plausible ones, what does that do? And we feed that through to inflation and to activity. And in what it shows you in that world is obviously you would see, you know, lower levels of activity, lower levels of inflation, and that would change the sort of monetary policy reaction there. And so you would expect policymakers to respond to that if we were to see that kind of those sorts of things playing out. Like I say, it's very much a scenario, but you could motivate it by weaker trade. So more trade policy uncertainty could be the driver. And it would suggest that, yes, monetary policymakers would respond to those things as you'd expect, and that would mean by loosening policy.
I would only caution, because that process led to some more substantial breaking or disrupting of supply chains, then we would have to look at the other side of the sort of coin, if you like, and say to what extent, as Claire rightly says, demand is disrupted, but to what extent is the supply capacity of the world economy disrupted as well? Because obviously the impact on inflation then is different.
Yeah. I mean, that's why throughout we've said that actually on inflation, it's not clear that it would necessarily be the case that these trade, you know, what we've seen on trade policy would be deflationary. It might, and that is our central treatment that we've taken in the forecast, and that's, you know, perfectly reasonable. But actually, you know, if you look at the recent experience that all economies around the world have seen over the last few years, actually it's really shown us the importance of supply chains, how complicated they are, and what that can mean. So it's not necessarily the case that this should all be interpreted as an issue around demand and not necessarily around supply. And it's the balance. You'll see both, and it's the balance of those two effects that matter.
And modelling those supply chains is another level of difficulty, as well as economists and economies throughout the world, you know, in dealing with the COVID pandemic, supply chains were a key driver there of the changes that we saw.
Faisal?
Faisal Islam, BBC News. Sorry, same sort of issue. Can you just go through how this filtered through to the MPC decision making? Was the trade uncertainty, it was a tight vote in a way, 5-4. Did that affect, was that a sort of marginal impact on the vote? Did it contribute to the fact that rates were cut, or cut by 0.25%?
Yeah, thanks, Faisal. I mean, the big point I would make is, you know, with due respect, and this is not a point of criticism, don't get me wrong. I mean, obviously much of the coverage in recent weeks has been on this point about tariffs and trade uncertainty. As you may have detected from A, the way we've sort of produced the materials, and B, my opening remarks, we actually really have come at it the other way around and said, look, we've got to go back to the fundamental sort of, you know, situation of the UK economy to start with, and what is the sort of, in a sense, the starting position there, and the position we've inherited, and the question, you know, big questions around inflation persistence, big questions around this mix of supply and demand, big questions about what's happening in the labour market, and how have those moved on. And then we brought into that, if you like, best way to think about it, how has the trade policy and the tariff situation then been layered onto that, and of course affected those situations. So that's the way we did it.
Phil, and then Ashley.
Thank you. I just want to switch to the vote split briefly. The three members of the panel here today were among the committee members who voted to cut rates by 25 basis points. But within that group of 5, there were 3 who were hesitant about that and were only persuaded by, well, it appears to be only persuaded by the trade moves, the tariff effects. I just wondered if you could each tell us where you sat within that group of 5 and what were the briefly, what were the key domestic factors influencing those decisions?
Can I slightly rephrase the question, if you don't? I'll put it into context, because if you read... I don't always get laughs in this press conference. We'll go out feeling happy now. Unless they're laughs of irony, I don't know. I'll try and get another laugh. We spent hours poring over language, as you may sort of expect. And the reason I say that is that the voting paragraph that you're referring to in the minutes actually uses the it's all put in the context of had. I think when I learnt Latin rather badly at school, it's the pluperfect tense, but if I'm wrong, then you can, well, I don't think you can blame my Latin teacher, you can blame me. The reason is, the reason substance is, what you're in a sense playing back, Phil, is where I think we each started from, if you like, sort of coming out of the last round. So some of us were in different positions as to where we sort of contemplated our next decision would be. And that I think, certainly I'll speak for myself now, was based more on the sort of question of sort of where, going back to this point about the sort of fundamentals of the UK situation were. So I think the reason we phrased the vote paragraphs we did is I think if you're in the position of saying, well, I was actually more confident in the view of the disinflation path of the UK economy, then the trade news is important, but it's not necessarily actually the thing that shifts me, because I was more of the view that we were going to go there anyway. And for some of us, and look, I'll answer your question by putting myself into this camp. I was very undecided, frankly, as to where we were going to be this time at that point in time. And then I've taken all the news into consideration, and all the news, by the way, critically includes how the UK situation has moved on, where I do think that there are some more bits of evidence that give me confidence, particularly in this question that I spent a bit of time on in the opening remarks about where the labour market's going to, and where there's a critical question about are pay awards going to come down to where we thought and where our agents survey thought they were going to come down to as this year goes on. And bear in mind that the spring, and particularly April, is the critical period for the pay settlements in this country. And I'm a bit more confident of that, having gone over the evidence, also having gone around the country and talked to quite a few firms. I'm a bit more confident about that. And then the trade news gets layered onto that. I'm sure not. Well, sorry, I was in the fairly undecided camp, actually. I wasn't particularly decided one way or the other.
Ashley, and then Joel.
Thank you. Governor, yes, your undecided nature and possibly the split kind of seems to just add to the unpredictability and uncertainty that we're all kind of facing. So now we have to guess a little bit more about what you're going to do. But in terms of NICs as well, I just wanted to note in your statement it says that actually you think that that's only had a very marginal impact in terms of kind of the labour market and inflation to come. I just wondered if you might be underestimating that, or how you feel, because it feels like there is that one line saying that it's a small impact, and yet it keeps being referred to in the statement as actually our bank agents are telling us this, are kind of, we know that actually it's contributing to kind of inflationary cuts and input costs rising. Yeah. So I just wanted to ask about that.
No, well, it's interesting, isn't it? So it's a fair question, actually, because in one sense, NICs were the question, if you don't mind me saying again, NICs were the story that everybody was writing the articles about a few months ago, and now it's trade. Our view is, look, the NICs story hasn't gone away. Actually, as we set out in the materials, I don't think we've had a lot of news on the NICs story. We haven't changed our view on how the NICs development is going to pass through. And just to recap that, as you may remember, we set out a menu of sort of channels through which NICs can come through. When we talk to firms, and again, I've spent quite a bit of time since we last were in here talking to firms, there was they tend to sort of tick all boxes. And that's reasonable, by the way. It's not because I think they're sort of, in some sense, hedging their bets. It's because actually, of course, you can use you can use most of the channels in combination. I think the one thing I would say, which we do point out, and this is not a change, but I just emphasise the point, is that there is unsurprisingly, the mix of the channels will change over time. Because some of the channels take longer to put into effect than others. So if you're improving productivity or if you're changing your workforce, and whenever your next pay settlement comes around. And so the point of that is, as we say in the materials, is that the effect on margins is the first one, if you like, to come through, because that's what happens if you don't do anything. If you do nothing, then that's the one where it comes through. And I don't think we've changed our view, but I think we've reiterated that that's what firms tell us, that in the first instance they'll probably see more of it coming through there, but obviously they will then be wishing to take actions that offset that.
If I can just add on that, because I think it is, although we say that the near-term impact of the rise in employer NICs on wages is expected to be relatively small on average, that, to Andrew's point, that is itself news, because back in the autumn, there was a lot of focus that this is going to be inflationary, but actually the contacts of the bank's agents, the ones who are talking about it, saying they're going to be reducing pay rates they offer by around 1 to 2 percentage points in response to the rise. So that, in the autumn, when we were talking about this, there was lots of discussion, this is going to be inflationary. There still will be some element, it'll be passed through that margin. But what our agents are telling us is actually it's going to be pushing down on wages relative to what they would have been. And also our agents and other contacts are emphasising that the national living wage is going to be a factor. So we have to take account of all of these factors.
Yeah, the national living wage point, by the way, is why I said you can't always use all channels, because if you've got more of your staff are on at the national living wage, obviously the wage channel isn't open in the way that it is if they're not.
So that kind of fits with that overall view that actually the increase to national living wage and these employment NICs changes will actually result in lower wages for workers.
No, the national living wage actually. My point is, if one of the channels to adjusting to the next effect is to actually have a pay settlement that is lower than it would otherwise have been. If your staff are at the national living wage, that channel is not open to you because the national living wage determines the pay, well, at least the floor of the pay settlement. Yeah.
Joel.
Joel Hills from ITV News. Can we talk about what are businesses telling you about US trade, Governor, diverting to the UK? To what degree is that happening? To what degree are they reporting that they're seeing that affect prices domestically? And how big a factor was that in your forecast? Also, you say that you think tariffs will probably lower UK GDP by 0.3% in 3 years' time. What will the impact of NICs be on UK GDP, please?
Sure. I mean, look, it's quite early for us to see in any of the hard data, any of the impacts. As I said earlier, the sort of dominating impact we've seen of these metrics around uncertainty. We're not seeing big changes in trade patterns yet. You wouldn't expect to, right? Because it's just too soon and also while the policies themselves are uncertain, you wouldn't expect large numbers of businesses to be making long-term decisions until some of that has resolved, which is why, good news if we're seeing that happening. So you're not seeing it strongly in the data. The most direct effect that you will see, and we would expect and we have seen, is obviously through the exchange rate and what that does to pricing.
Heather, and then we'll go Jeff.
I just wondered if you could talk us through, you talked about the sort of downside for growth scenario. I wondered if you could talk us through the other one. I know that none of you were in that camp necessarily, but you've talked about the margin of slack that's opened up and that you expect to widen. You've talked about the fact that continued restrictiveness of monetary policy is weighing on growth. You've talked about NICs potentially pushing down on wages. I just wonder, how does that upside scenario in which you get these second round effects play out? It seems a little bit hard to square with your sort of central expectations.
Sure. Yeah, actually, I'm glad you've asked, and it gives me an opportunity we'll all enjoy for me to talk a bit about scenarios. I would caution against seeing them as, this is a picture of the world and everyone's in one of these places. That's not at all what we're trying to do here. What we're trying to do, because it's more useful to us as policymakers, is to say, well, look, what if some of the specific economic mechanisms, the ways in which things change in the economy were a bit different to in our central forecast? What would that do to the wider economy? So you could, for example, believe parts of the upside, the scenario with higher inflation and parts of the downside. So the way we've motivated that scenario, the way that the staff have put it together, is it assumes two things. It assumes both that you have more persistence in inflation expectations, perhaps because we know that we anticipate that inflation is going to go up a bit this year, particularly for the more salient items, energy, food, the things that people notice. So what would happen if people's expectations were a bit more persistent around inflation, and also we didn't see the recovery in productivity growth that we assume in our central forecast? So imagine a world like that. If you were in that world, what would then happen to inflation, to output? Now, it's not the case that, this represents a particular member's view, or that we'd all sit there and be able to put a probability on this. In fact, you might believe, for example, that productivity may not recover as quickly as we have it in the central forecast, but also there is a risk of weakness to demand, which is the other side. So it's really about teasing out, actually, what is the economics, how could things be a bit different, and what does that mean for inflation, for output, and for policy making. So it's not, if you like, there's a scale here from one end to the other, and people are somewhere or otherwhere, and necessarily the people that voted in a particular way believe in the downside scenario, or those that decided to, voted to hold rates believe in the upside. It's actually, as policymakers, we talked about and went through what would the world look like in those situations? What does that mean for policy? If you believe parts of those sorts of stories, what does that tell you? It's really about helping us think around uncertainties. What are the things, and being a bit more specific, but what are the things we're uncertain about? What would those mean, and what would be the sort of implications of those, and factoring that in? So, I appreciate that's a bit more complicated than basically saying, look, I'm 20% there and 60% here, and therefore my vote next time will be that. That's not how we're using it. We're basically saying, look, how can they help us understand the economy differently, or how it might be different, and what would that mean for how we want to think about the policy that we're setting now?
And if I can just add to that, because we recognise that using scenarios to reflect uncertainty is absolutely the right thing to do, but on a committee where there are 9 of us, where we're personally accountable for our votes, then what you just did Heather, of trying to map it across to which scenario you're in, I completely understand, but that isn't the way it works in practice, because we're looking at mechanisms. So I'm kind of voting with the majority, but I am worried that we're not going to see that recovery in productivity and supply, which is a kind of fundamental judgment to our baseline forecast. So, and if that on its own happens, that would tend to push inflation up relative to the baseline forecast. So and the challenge we have, I think, as we move more and more into this world of using scenarios, is explaining how we're using them, and how, and what they're not.
Jim, and then Helia.
Thanks for taking the question. Just a couple of points here. What about your first point? What makes you so confident that there aren't going to be more and repeated increases in administered prices for the rest of this Parliament? I mean, I appreciate you can only act on the basis of declared fiscal policy. That's your constant line. But I mean, the demographic pressures, the long-term pressures on the government, on public purse, aren't going away. So when you say we should not expect these pressures to persist, where's the confidence coming from there? And secondly, was the committee able at all to talk about the impact of the trade deal with India, and what the effects of the was the committee able to consider at all the effects of the trade deal with India and what effect that might have on labour supply over the next few years?
Well, I'll take administered prices. Do you want to? Yeah.
I mean, look, on the India deal, we didn't have the details of it for the discussion. You know,
on administered prices, Jeff, can I just sort of break it down a bit? So half of that sort of hump in inflation is actually energy. Now, of course, the administered element of that is the UK's effort for setting the price cap, the Ofgem mechanism. What we can say there is that actually during the period of doing the forecast and since the last Ofgem observation window, the energy prices have come down. So one of the reasons that we've got a sort of slightly lower profile of inflation than we had back in February is energy prices. Now, as we know, things can change. This is highly volatile, but at the moment, I mean, we've obviously got that benefit coming through. So that's about half the story. And the other half is a collection of other things. The point we made about persistence is a slightly different one to the point you make. It's actually about that will this set of administered price increases cause second round inflation effects? You make a reasonable point. Will there be further administered price increase? I think you were saying. Will this just be the first of a? Yeah. So we condition on unannounced policies, so we don't sort of predict, are there going to be further, administered price increases of a more sort of policy-driven variety. I think the only other thing I'd say is that the third sort of bucket in that category, which I did mention in my opening remarks, is those prices which are administered in the sense that they're indexed. So you see some of that in the services, some sort of mobile phone bills, for instance. I mean, they're actually, that you might say is not quite true to the sort of description we put, because I would hope they are open to competition, which would obviously reflect sort of balance of supply and demand. I hope in commas.
Helia, right up at the top there. Yeah.
Hi, Governor. Helia Ebrahimi, Channel 4 News.
Hi.
Uncertainty seems to be the key issue for the bank's forecast, but for businesses and households, what's your message to people at home? Should they take today's rate cut as good news for them, or is it a sign of the UK economy being in trouble? And just on today's trade deal, if today's trade deal is just a sectoral carve-out and leaves 10% in place, can you just clarify, would that have any impact on the downgrade in growth?
Well, let's wait and see what it is. I say we generally don't know what's in we've not been involved in the process. We don't know the content of it. So I'm going to sort of say let's wait and see on that front, and then we can factor it in to our projections going forwards. On the uncertainty question and how to sort of treat this or how to regard it, but the one thing I would say, and it comes back, I think, to one of the very early questions, if not the first one. There's plenty of people sort of been writing, I've seen, that the bank is going to, quote, slash its growth forecast, and we haven't actually, is the answer to that. We've made some revisions both ways if you look at the growth profile. So the very front end of the growth profile is slightly up. That's got really nothing to do with trade. It's got to do with sort of data that's come out and how we've treated that. The growth profile for the sort of the middle of past the forecast, so think about next year, really is a bit lower, but it's not hugely lower, frankly. It's a bit lower. And then actually for the outer end, it's pretty much the same. So we haven't actually, this is not a sort of doom and gloom, I would say, at all in that sense. So if you're going to write an article saying we've slashed our growth forecast, we really haven't actually, is the answer. So I hope people regard that. Obviously, I'd like them to regard the rate cut as the appropriate response to the circumstances which we find ourselves in. Unfortunately, to reiterate the point we've all made, yes, we are living in a world of very high uncertainty.
If you wanted to illustrate that, we put a lot of detail on the baseline forecast on page 22, and you only need to look on the line there for business investment, which we know is the component of GDP most affected by uncertainty. And that averaged 3% in the decade up to 2007, 4.25% in the decade up to 2019. And we're we've had to revise down our forecasts again. So we've got 1.5% growth for this year, 1% for next year. And if you had a reduction in uncertainty, you would imagine other things equal, that would support growth. And then the bottom line of that table shows the household saving ratio, which has gone up to 10% last year, and we've got it at 10.5% this year. Again, imagine some of that is precautionary. Our surveys show that. So other things equal, if there was less uncertainty, you can imagine consumers and businesses would feel a bit more confident. Then it does come back to issues like on the supply side, is there the capacity for the economy to grow? But that's why I say, but other things equal, it would be supportive of growth if there was less uncertainty.
Yeah, the investment story is a big part of the productivity story
Yeah.
in that sense. I mean, I made a speech a few weeks ago and emphasising this point that I think raising the level of productivity growth is critical to the question of the supply side. And of course, it matters to us here in terms of the supply-demand balance.
Isha and then John Paul.
Isha Nelson from the New York Times. So you've talked about uncertainty a lot and also unpredictability. Can you just clarify what you think it would take to feel a meaningful reduction in that uncertainty? I'm assuming that today's UK-US trade deal is not enough for that kind of across-the-board feeling of uncertainty reduced. Would you be looking for the outcome of China talks, EU deals, all of those reciprocal tariffs to go away? And then just to go back, before we've talked about that correlation between UK assets and US assets has been increasing in the past, and particularly at the beginning of the year, we saw a lot of volatility in gilt markets that kind of seem to be generated from US Treasury markets. Is there anything that is, can you just update us on that, whether you think that's increased, if there's anything that could be done from a financial stability perspective to ensure that UK markets aren't as kind of beholden to what happens in the US? Thank you.
Sure. Well, start with the uncertainty point. You're right, and that's why I said in my opening remarks that while I very much welcome, if it turns out to be the case, that we're going to get the announcement of a US-UK trade deal today, I very much hope it's the first of many, because it will obviously the point that will address your question of uncertainty is actually we need many trade deals actually, because this addresses trade across the whole world economy. So the UK, as you rightly say, is only a part of that. So that's what we need, and I think that. Would be a big part of reducing the level of uncertainty around trade policy going forwards. I think we also need to look, this is a deeper question, at how trade policy is made, and greater confidence in the multilateral process, but that's a much deeper and bigger question going forwards. On the question of markets and financial stability, we've obviously had very volatile market conditions. What I would say is this. And I'm going to say, so far, touch wood, and so on. Actually, the financial system has come through, robustly, in the sense that the structural sort of elements of the financial system have stood up. If you were at our FPC press conference, back at the end of last year, we were talking about the system-wide exploratory scenario that we did last year. Some elements of which, do obviously have quite a striking resemblance to some of the things we've seen. So that was, for us, a very helpful guide to understanding the resilience of the system and how it might be affected. And I will take the opportunity to make this point because it is fundamental. On this whole question about where regulation goes going forwards, I don't for a moment, as a regulator, because we are a regulator, obviously, in any sense suggest that every regulation we have is perfect. Of course, they're not, actually. However, there isn't a trade-off between financial stability and growth. This is an absolutely critical point. We've learnt that lesson the hard way in the past. And recent weeks, to me, have underlined why it's so important. We would have been facing a much more difficult situation if we had been, as well as dealing with, turbulent markets, volatile markets, we'd had, parts of the financial system which were, in trouble in the sense of failing, and we haven't had that situation.
John Paul, did you? Yeah.
Hi, John Paul Ford from the Daily Mail. Thanks for taking my question. Couple of things. First, do you agree with the IMF that the main reasons for the sluggish growth in the UK are domestic, rather than, as the Chancellor suggests, to do with the changing world? And in relation to that, is it actually only the prospect of falling rates, or mainly the prospect of falling rates, that are boosting growth prospects in the future, rather than anything the government is doing? And just quickly on unpredictability, is this in fact the most unpredictable scenario perhaps you're having to deal with compared to previous ones, given that you're dealing with someone who changes his mind almost, it seems, every day?
I want to get Claire to come in on scenario, but let me start on the first part of your question. I mean, I'd refer you back to the speech I gave in Leicester a few weeks ago, because this question about growth is critical. Dave made the point earlier, quite rightly, that we had a higher rate of potential growth if you go back, sort of pre-financial crisis. Actually, so did most countries, actually. So the UK is not unusual in this respect, by the way. And we've had a lower rate of potential growth, for the last 15 years, or a bit more than 15 years now. And as I said in the speech, predominantly that is about productivity. It's not actually a story about labour supply so much. It's a story about productivity. And as Dave rightly said, you can link that story on productivity to investment in the economy. So addressing those questions now, I speculated in the speech about what are the determinants of that. I think there's more than one. I think the question about ensuring, for instance, investment in the real economy, so the pension fund question is important. But there's a much longer term and international question about waves. I made the point about what we tend to call general purpose technology innovation. There are waves of innovation which do raise productivity and investment in the economy. And I addressed the question, is AI the next wave? Well, maybe it is. I do take the view that we've got to be set up all round to take advantage of that, because that is, if you look at history, that is the thing that will actually raise productivity growth.
I couldn't agree more on the importance of productivity and its role in the sort of short, medium and long term in terms of activity. And we've talked before about the importance of, appreciating that activity is driven by both demand and supply, and you shouldn't just see it from a demand lens. I mean, the other thing I would say is in the near term as well, there are other reasons that we expect growth to strengthen. We do expect real wages to rise in the coming period. That will lead to stronger consumer demand. We have, as Dave says, a very high savings ratio at the moment. That could come down. Obviously, in reducing interest rates, we're reducing the amount of monetary restriction in the economy. So there's also reasons to expect the near-term picture to improve as well.
And although we're dealing with unpredictability in trade policy and one has to kind of keep perspective, because the reason we've been talking about uncertainty so much over the years is because the world economy has had to deal with a lot of different shocks. So, we did see in early April that the VIX, for example, in terms of equity market implied volatility, that rose to its highest level since 2020. But that's since 2020. It wasn't off the scale. And actually, in the last couple of weeks, and again, Andrew was touching wood, markets have been calmer, although they still remain quite volatile. And that's more just a kind of feature of markets, because partly they're responding to fundamentals, and then you expect market pricing to change then. And then there will be things, the adjustments that have to be made. I mean, Andrew emphasised how our system-wide exploratory scenario pointed out the adjustments that may have to be made. So in early April, we did see some deleveraging. But when that deleveraging happened, people were selling, but there were also people buying. So markets found, settled in a new place. And, we tracked that volatility very carefully, as did other jurisdictions. But the overall system has been resilient, as Andrew emphasised, which is crucially important in terms of financial stability.
Let's go to Maureen and then David.
From the Times. 2 questions, if I may. Given that the UK is more exposed to the indirect impact of tariffs, is it fair to say that whatever trade deal is signed today, the sort of game changer in this relationship is actually between the US and China? And it's only if we get a major de-escalation on that front, given that China is subject to 145% tariffs and they go both ways, that is going to be the key relationship which will maybe lead to a material change in your outlook on what tariffs mean for the UK rather than what's going to happen this afternoon. And just on the inflation persistence, beyond the creep up in household in inflation expectations, what other evidence do you have that this temporary spike could lead to more second round effects beyond what you're seeing in survey data? Do we know anything else beyond what we knew in March or February about the risks of more persistence through the second round?
I'll start off on China. I think you're right, Maureen. China is is obviously a very important part of the trade story, and obviously the tariff action taken on both sides in the China case is much more substantial. So I think whatever, in a sense, transpires between the US and China will be an important part of this story. I'd also go back to just to emphasise a point I made earlier. Actually, I think it's very important, therefore, as to where US and China get to in whatever discussions they're going to have. I think it's also important then to come back to this point about what I might call the more fundamental point about the way the world trade system works and the way the multilateral system works and the way the World Trade Organization works. Because although I would take issue with the idea that every trade balance must be in balance, because that's not the way trade works. It is important to have a much clearer sense of what are the long run, if you like, unsustainable imbalances in the system, and what we should do about them, and how the multilateral system can assist in that respect. I've said it once or twice. I do think that there is an imbalance there. I think China's household domestic demand is weak. And that's accepting the fact that China is has developed, and of course that's to be expected. It has had weak household domestic demand over a long period of time, but obviously in the way the trading system works, there's the other side of that coin is somewhere else. So I think we know that the other side of that story. So I think the question about how the international system, which we're all involved in, can assist in identifying those more persistent issues, as opposed to the sort of the issues that aren't issues because they're just the transient nature of the way trade balances work, is critical.
Let me talk a bit about inflation expectations and the risks about that. I mean, as you'd anticipate, we spend a lot of time looking at, monitoring, thinking about inflation expectations for households, as well as for firms and in financial markets. And you're right, they've household expectations in particular have ticked up, and so we're thinking a lot about that and why, and we do a lot of analysis as to what might be driving that and those sorts of things. I mean, I would reiterate, in our expectation is that the increase in inflation we're going to see later on this year will not be persistent, and it will come back down, and it won't lead to second round effects through people's expectations. That said, we do and have done a lot of analysis of things like, what is the relationship between expectations and people's perceptions of inflation? How do people respond to inflation for different goods and services? And what are the things that sort of drive people's awareness of inflation? And we've published quite some good analysis in that space that shows basically some items are much more salient than others and affect people's views of inflation more than others. We've done lots of work looking at, are there particular sort of trigger points for inflation at which people notice some levels more than others, those sorts of things. I mean, I would say we're expecting this increase in inflation later on this year, for particular driven in large part by some of the items that Andrew's talked about. We're not at all complacent about that, and we also recognise that will be incredibly painful for people, particularly where this is around energy, food, really difficult. It isn't, however, anything like the sorts of numbers that we did see a few years ago, you know, we're talking about peaks. Our estimated peaks around 3.7% later this year. Obviously, that's far less than it was, but of course, difficult for people, and of course, different people have very different experiences of that. No, we're not seeing evidence of that, and actually in some of the areas where you know, we have seen changes in inflation. You know, if you take, for example, where at the moment we're seeing slightly higher levels of food inflation than say pre-COVID. Actually, our agents tell us that we might have reason to expect more competition coming for some of those items. So, you know, it obviously varies by product, by sector, and we're monitoring it carefully. Our agents are out there talking to and gathering that intelligence, so we've got it as much as we can, you know, as fast as we can and as comprehensively as we can, which we put alongside this sort of research that we do on some of these other factors. So we're not sort of seeing evidence of it, and actually in some areas quite, you know, the contrary, particularly as I say on, for example, food, which we know is incredibly important to people and drives a big part of people's experience of inflation as they see it.
I think we have time for two more really quick ones, David, and then Anna.
Thank you, David Milliken from Reuters. First question, really how concerned are you that we're likely to see larger multinational companies decide to put up prices in the UK as part of essentially a global pattern of price rises? And secondly, just a more technical thing, given some of the volatility that we've seen in bond markets and particularly 30-year gilts, whether that's causing the Bank of England to think that when it comes to planning QT for the next 12-month period starting in September, whether you might rethink how you approach this and the balance of gilts that you sell?
Well, I'll take the first one. Dave will do QT. I think it's an interesting question about global multinational companies. David, you asked a very interesting question, and one that we've got to, I think, keep a very careful eye on, because we've distinguished in our analysis the way in which tariffs will have a different pricing effect between countries on either end of them, as it were. Whether you're in the country that's in a sense setting tariffs or the country that's on the other end receiving them. Now, your question in a sense quite rightly says, well, hang on a minute, is there something else that cuts across that, which is global companies that don't make that distinction and just say, we're going to impose a pricing solution which goes right across the world, irrespective of those differences. Now, I think we have to watch. I think we do have to watch that carefully. I think it's too early, really, to reach a conclusion on evidence. I don't think we've seen a lot of evidence yet. One or two bits maybe, but we haven't seen a lot of evidence yet. But I think you're right to pose the question, because it would cut across that rather conventional trade approach model, which would say, no, there's a difference between these two things.
Yeah, just on QT, I think it's important to emphasise that through this period, the MPC hasn't changed the size or pace of the QT envelope and the way that the bank is then delivering it for the MPC. So we've got that 100 billion reduction that, as you were saying, takes us up from last October to this September, and with the process will get going soon. It's an established process now for the MPC to consider what it wants to do for the next year, and I'm certainly not going to anticipate that here. I think it is then worth, just within that context, making very clear that it was the bank's executive. We made a decision back earlier in April to switch the ordering of our QT operations in the context of the market volatility. So we swapped out the one long auction we had and went ahead with an additional short auction instead. That made sense given market conditions, but that was very separate. The MPC, as we flag in the minutes, was informed of that, but that was a bank executive decision.
Great. Anna.
Thanks. Yeah, Anna Wise from Press Association. Thanks for taking my question. Mortgage rates have been slow to come down, but at the same time, savings rates are dropping at a much faster rate. Are you conscious of this really? And do you think people have confidence that your decisions are feeding through to the market?
Well, That's a good question. Mortgage rates nowadays are priced, because the large majority of mortgages are now fixed rate mortgages over typically sort of, 5 or 7 years, some are 2 years, but 5 or 7 years. They're priced off the swap curve. So they're priced at rates which are set in the market. Obviously, they bear a relationship to our decisions on the bank rate, which is how obviously monetary policy transmission works. But of course, markets anticipate what we're going to do. So those rates have already moved around in anticipation of the announcement we made today, for instance. I think broadly the movement of mortgage rates and the swap curve broadly reflects the movements in rates. So I'm not particularly surprised. I think there's been, as we've been saying throughout this this conference, there has been, of course, more market volatility. Some of that has come through into rates. There's a question about how much term premium effects are coming through, which would change that relationship. But still, broadly, there's a relationship. Now, on deposit rates, as I said before, I would draw the distinction between what I call sight deposits, payable on demand, and term deposits. Term deposit rates have moved much more in line with what term deposits over a period of time, that is, have moved much more in line with our rate decisions. Sight deposits have not moved as much as in line. And I've said at the Treasury Select Committee once or twice when asked this question, I'm not surprised by that, because one of the things that has really changed in the last decade is that post-financial crisis, we now have a bank liquidity framework. In other words, a framework for banks maintaining their liquidity buffers. The consequence of that is that the value of term deposits is a lot more to the banks than sight deposits, because they obviously don't run as fast. That's the simple fact. So I'm not surprised that term deposits are more responsive to pricing, those sorts of pricing signals than sight deposits.
Great. That's all we have time for. Thanks, everyone.
Thank you very much.